Entries are something that every single trading system on the planet needs. However, most people overcomplicate them and they think that entries are going to solve a broken system. So in this video, I'm going to simplify entries for you as much as humanly possible. And you can see exactly how I do it and how I manage it. So the first important thing to understand is that most traders confuse the difference between traders and investors. These are different groups of people. So let's just say that we were looking at a particular company, right? And we knew that, okay, in 5 years' time, roughly, we expect this company to be worth more. That's great. But in between, we're going to have lots of periods of up and down swings, way more than this, depending on the time frame we're looking at. And so an investor will just buy and they'll hold through all of this. And they'll perceive all of this stuff as noise normally. As traders, really the main benefit that we have, in one word, is timing. Now, why is this important? Well, because timing, essentially, broken down to the most basic level possible, is if we have an overall bias, which is what I mean when I say you need to have a trading system that works before you even think about the entry. Most people go straight to entries thinking that they're going to fix a broken strategy there, and you're just not going to happen. Anyway, but the whole purpose of timing is essentially to catch these points. We have the benefit as traders of going, okay, I'm going to buy here, I'm going to sell nearer the top, I'm going to buy here, sell nearer the top. Obviously, it's not going to look this perfect, but just as an example, that's the whole idea. And the whole idea is we're reducing our exposure to the down and we're increasing our exposure to the ups as much as humanly possible. This is the key. And it's very important, therefore, that we need to have an idea of the underlying thing that we're trading, either going up, down, or sideways, whatever our system actually is. In other words, we need to be okay at predicting the environment itself. But let's just assume that you have got that. What is the next stage? Well, in order to kind of understand that, we need to first of all zoom out a little bit to where people get stuck. Because one of the things you'll notice when you look at price is when you are normally taught, you'll be taught something like this. It will be like, okay, we have a high, we have a high low, high low, high low, high low, etc. Now, this is fine, but this is the exact same thing as what I would call a textbook understanding. This would be the same thing as if you think about people that have gone to university and they study business, and then they leave university and they enter the real world. And whilst they are maybe better equipped than someone who hasn't even studied business before, they're really they're at basically a level playing field with every other person trying to start a business. And the reason for that is because textbook understanding is very, very different to reality. In reality, things never look so clean. And in the context of trading, this couldn't be more true. Throughout this entire period, what these ups and downs probably look like are much more unpredictable. You know, you'll normally have these patterns right here that are kind of up and down, and this is quite an extreme example depending on the time frame you're looking at, but something like that. And so why is this important? Well, it means that when we are looking at price to define our entries, we are going to be exposed to more complexity. And as a general rule of thumb, your complexity is going to come from a few different areas here. So complexity, which is basically what we're trying to avoid, comes from looking at more price, lower time frames of price, and more rules. These are the three main sources. And so most of my work is about trying to take these down as much as possible. Now you might be thinking, well, complexity, but that could mean a good entry. And I'm going to explain to you why that often isn't the case. So what most traders start off as when they get into trading is they start as discretionary traders. And this basically, if you don't know, is just when you are trading based on a level of intuition. You go, okay, this looks good, I'm going to trade this. You're not trying to overly define everything. But what happens to all traders in the beginning is they eventually start losing. This happens no matter how good you think you are. This happens to all of us. And so what they begin doing is they begin saying, maybe discretionary isn't the right approach. Maybe I need something systematic, meaning something that is based on clear-cut rules, meaning if this happens, this happens, this happens, I get in. If this happens, this happens, this happens, I get out. Black and white, simple. In theory, a robot could do it. And so this is where most people go to. Now, the problem here is that you are trying to make the unconscious conscious. Now, what the hell do I mean by this? Let's imagine that you were walking down the street and you were texting on your phone. And as you were walking, you were naturally doing all the things that we would be doing. You'd be balancing, you'd be making sure people walking towards you weren't smacking into them. You were reading the message on your phone. You were then interpreting that message and then responding based on that, and then figuring out where you're supposed to be going and all these things in between. But that stuff we just take for granted. It happens automatically. Now imagine that you try and do all of those same things and you try and do it in a robot. That is going to be extremely difficult. It's going to take you your whole life because all those things you take for granted, you need to code it. How do you get it to balance? How do you get it to walk? How do you get the signals to be able to, I mean, just making it walk alone would probably take your whole life. Then it's like, how do I get it to understand the messages that it's seeing visually, then translate that into typing on a keyboard to then, balancing and making sure you don't bump into other people. So many things we take for granted. And that's an example of trying to make the unconscious conscious. So why am I telling you this? Because in trading, it is the exact same thing. The more you try to turn things into this ultra sophisticated rulebook, the more you're going to run into complexity. And often from that complexity, you're either going to burn out or you're going to over engineer something that doesn't need to be engineered. Let me give that to you in the simplest way possible. If we look at actual prices, if I went to a beginner, for example, and I said, what phase or what state is the market in this period versus what state is the market in this period? Everyone can go, this is basically trending. This is basically going sideways. That's without you knowing anything about how to define price. However, let's just say, because we're on the 1 hour time frame right now, that we wanted to define everything in price and we were ultra aggressive. That means that, for example, let's just say we defined this particular wick as the high, we then broke above, then we started looking at this as the low, and then we broke above, this became the low, then this became the low. And at this point, maybe we then saw this as a trend. Then we're like, okay, well, is this right? Is this wrong? Are we then, or maybe we're predisposed to go down, then we break above again. And then we're like, whoa, okay, maybe that's too aggressive. Maybe we're going long here. Then we go back down again. And so you can create tons of confusion. That's just a simple example, but there are so many ways. Think back to any time in your trading where you've tried to create a trading plan, you've been looking at price, trying to decode it and figure it out, only for you to just end up more confused and not having an idea of, okay, how can I actually turn this into something practical? It just feels like whatever rules I apply eventually get broken. And that's a common thing. And it's a reality because you're trying to apply a textbook understanding to a dynamic, changing, moving environment. Whereas if I was just looking at it going, okay, I can visually see that overall the momentum is up here. That's something that you often take for granted. And it's one of the reasons why over the course of your journey, especially in the form of technical analysis, most traders will often find themselves edging back to a hybrid or a full discretionary system. You'll see this happen quite a lot in the space. And for me, the best has always been to focus on this hybrid approach. So that's going to be an example of more rules in trading. And as an alternative to rules, just to fix this little point here, is we want to be going for principles over rules. Now, what does this mean? It's the difference between saying that a trend for me is when exactly this, and exactly this happen. And instead it's going when we are overall going more up than down, because that allows for interpretation to use different tools rather than trying to define the exact tools we need to use. In other words, if we were looking at a trend and we were using a rules-based approach, we would be saying things like, again, if it was technical only, we'd be saying that the moving averages need to be up. We need to have structure, breaking with XYZ pattern exactly, and XYZ. However, with a principle, we'd be saying, is the momentum up? This is a very simple example, but it just gives you an idea. This allows for you to use the tools mentally that are available and just use your natural inbuilt intuition to understand, look, is this going more up than down? You will have naturally picked this up more. The more you look at charts, you'll just tend to see certain things. Now, the next thing to keep in mind is the lower the time frame of price, the more noise you're going to see. And so, for example, let's just say that we were looking at a particular stock here, and we thought that over our time horizon, which is something I'll get onto in a minute, we expect it to go up. But in between, it could look, all sorts of ways. It could go down for a bit, up for a bit, all sorts of things, right? Before it gets to our overall higher level. Now, the time frame that you look at this on is going to create a big difference into how much noise you can look at. If we looked at this on, let's just say, I'll just use mine as an example. So I have a 1 to 3 month time horizon. Now, that doesn't mean that I'm necessarily in trades for 1 to 3 months. It just means that the forces that are pushing the markets that I'm picking, they typically last for 1 to 3 months. I will normally be in and out within that period. So it fits my personality really well. I'm a little bit more active, but I'm not, just flying blind or basing things off pure technical analysis. And by the way, one of the downsides for picking a pure technical only method for the direction that the main part of your strategy besides entry is you can't really define this, like not really, because the forces that you are playing off of are purely technical, you're just riding momentum, you have no idea if it should continue, if it shouldn't continue, that is going to be one of the downsides of a pure technical only system. It can work, you can rely on risk management, that's absolutely fine. But I prefer to have more of a professional approach, which basically just adds a predictive layer, looks at the actual things driving markets, and then uses those to create the stock picks that I'm looking at each week. If you are interested in just seeing how I do that so you don't have to do that for yourself, you can go check out Inside Alpha in the description box below. I share that with you guys every single week, the exact stocks that I'm looking at, and a little bit of insights into why and how I'm timing them, etc. But no matter what your system is, if you don't want to do that, that's completely fine. If you've got your own method, whatever it is, just have a rough idea in your head backed up by some kind of data as to what your time horizon is. Now, why is that important? Because this is going to define what is too low of a time frame. So if I know that my time horizon is 1 to 3 months, then does it make any sense at all for me to be timing the market using technicals, which is how I time things, and we'll get onto that in a minute with the entries, the whole reason you're here. That's going to define what the time frame is to get in. So a 1 minute entry is going to be really, really stupid, because let's just take one of these segments, for example. Let's just take this little segment here. That could be a week's worth of behavior, could be 2 weeks. And if I'm trading every single buy signal within there on the 1 minute, I'm going to get chopped around so much I could lose completely. And so the message here is that a bad entry, or an entry on too low of a time frame relative to the time frame that your strategy is based on, can destroy a strategy. In other words, in plain English, the lower the time frame, the more noise. You've probably heard this before, you've probably seen and experienced this in some way or another, but this is something to really keep in mind. And so when we're narrowing down complexity, the easiest way to keep things more simple, if you are someone that struggles with the overwhelm side, is just to move up the time frames relative to what you're doing. A lot of people think, oh my God, I'm going to be sacrificing my risk reward a lot. Maybe slightly, but if you do it correctly, probably not as much as you think. And also, the amount that you lose, people often underestimate the amount they are losing from chasing those monster risk rewards on tiny timeframes. Most people massively, massively forget the pain that is associated with that and the struggle with that, because they are so obsessed with trying to get better risk rewards, when if they were just a little bit more patient, they would often do a lot better with less work. And so final thing is more price. So this is just another way of saying the shape of price. So this is really important. Similar to what I mentioned over here, the big differences between a textbook understanding and reality is that the actual shape of price will be different. When you're looking at price, there are a lot of different variables that you're really looking at. You're looking at momentum in lots of different formats. You're looking at the size of candles, size of overall moves, pullback sizes, level types, wicks, loads of things in between. Think about any technical system that you've learned for entries or analyzing price. You'll know the amount of things that come with it. And the more you're looking at price and the more of price you're looking at, these things are all multiplied. So if you're looking at the 1 minute chart for a system like mine, that's kind of a 1 to 3 month time horizon in terms of the bias, that's going to create so much noise because I've basically amplified all these things by about 100 to 1000x. That's not going to create a nice simple framework in my mind. And so the core of the video, right? Now we can get into actual entries, which I know has taken us a little while to get there. So the core for me is, how do we take all of the principles that we've established of cause complexity, and how do we distill this down into something that is going to free us from complexity and give us something nice and simple? We want to do the opposites of all these things. So for me, it starts with removing as much of price as possible. Now, what I mean by this, I'll show you in a minute, but this is going to be a little bit contradictory in a way, because I spent the majority of my life only trading technicals. I've traded every technical entry system you can imagine: Wyckoff, liquidity, SMC, fair value gaps, break and retest, support and resistance, moving average crossovers, yada, 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 yada. Done all of it. And so I found that throughout that whole period, though, the best thing to do is just to keep it simple. All of those things can work, but when you start optimizing for what works best for you, often the best results follow, because it's difficult to stick to something that doesn't work for you. And most people, most humans, aren't wired to be traders. And so picking something simple is a huge advantage, because not only can you learn quicker, but also you're not constantly facing so many losses because you're trying to be ultra technical and have everything perfect. And so removing as much as price as possible. I'll show you how I do that in a minute. Using the right time frame confirmation and reducing things to, in fact, I actually keep rules. Because, and then you'll see why I do this now, but what I mean by that is, because I'm removing as much of price as possible, it means I can still use rules in a way that makes sense. So probably a better way of putting this here would be, I'm replacing rules with simplified price. Let me just show you this, because otherwise it's not going to make any sense. So how do we translate that into something actionable, into something simple? Well, the first thing to understand is, as I've said before, and this is something I really want to make sure you understand, if you do not have a bias, if you do not have a strategy that works, this entry method is going to be meaningless. Any entry method is going to be meaningless. But assuming that you have that, and by the way, this is a stock that is on my weekly watch list. So typically there's about 20 to 30, sometimes 35. And this is one of those on there right now. But this popped out a signal around about here. This is not a buy signal for me. This is a time when I will start looking at the stock and then waiting for a technical signal. This was a long signal, and so I'll be waiting for a buy signal. Now I'll show you how I do that personally. So I go to the daily, and the indicator I'll be using is a simple RSI. That's it. Nothing fancy, nothing crazy. Why do I use an RSI, you might be asking? Because it distills all of the movements of price into a simple up-down relative strength meter. If you think about, and if you look into the calculation of the RSI, the relative strength index, it is exactly what it says on the tin. It is just measuring the relative strength, which means it filters out tons of actual noise from just looking at price. And if you are somebody who prefers simplicity, this is something that is a big thing. Now, does it mean you have to sacrifice really, really good entries? For the most part, absolutely not. And so after I got this, waited for the daily confirmation. And so daily confirmation for me is about closing below the 30 level and then closing back above it. I'll show you the settings in a minute. And so that would be the close of this candle right here. So from that point, that's going to be the first major entry. Stops a little bit below the low, nothing fancy there at all. And then from that point, we can scale in, which I use the 1 hour using the exact same signal, just with the 1 hour RSI, which I'll show you in a minute. Or if we miss this first position, we can just trade the 1 hour signals in and of themselves. But it's important that I always wait for the daily first because of the time horizon that I know that my bias works on. There's no point me using the 1 minute, for example. In fact, let me just show you. If I used the 1 minute throughout this whole period, there'd be loads. I mean, look how many signals I would have got that would have been completely wrong. So many of these signals over and over and over again. I mean, it would have just destroyed any loss before, any edge before it even had the chance to become real. And so after I've had that momentum aligning on the daily, then I have permission to go down onto the 1 hour, which is my time frame of choice for this, and begin experimenting with things a little bit more. And so that for me is just waiting for the same signal again. Sometimes it's going to just miss it, and that's fine. Other times it won't. Again, that's also fine. Excuse me. I have experimented. You'll see I have this faint line at the 40. I have experimented with using this for the 1 hour to be a little bit more aggressive if I feel like it looks right, but that's something that's a bit more discretionary in my own system, in full transparency. For something really simple and rule-based, there is absolutely nothing wrong with just missing entries and just waiting for a clear signal. All I'll be doing in this case, this was a signal, so the actual close of when we didn't technically touch the 30, but I'm not religious about it, so it's close enough. And then it closed back above. And so for me, the entry would have been here. Now, from my old technical background, looking at this and having an entry on the close of that candle, I'll be like, oh my God, this looks like way too high. Like, how could I ever trade something where I'm buying the highs like that? That just comes from my own background where I wanted to get super sniper entries the whole time. But the reality is that when you actually have a reason why the market that you're trading should continue to go up, why it should continue to trend, it doesn't actually matter so much about a lot of these technical rules that we kid ourselves with. It's a lot easier and a lot simpler to focus on the things that actually drive the needle. And the biggest thing, as I always say in my videos, is environment selection, knowing how to pick the markets that are best aligned to your strategy. If you have a trending strategy, how do you pick trending markets? If you can't answer that question, it doesn't matter how good you are at entries, doesn't matter about any of that. Same thing as if you've got a sideways market, you're trading consolidations. If you can't spot consolidations and you keep applying that in a trending market, you're screwed. Okay, and so you need to pay attention to that stuff in order for it to matter and be important. In terms of my stop loss placement, I normally put it below the most recent low. Nothing crazy. I won't hug the low normally. I'll just keep it nice and simple. This entry wouldn't have been perfect. Next example I'll show you is Monster Energy, so Monster Beverages. This has been a very top performing stock for a decent amount of time now that has been and is currently on the watch list as we speak. And again, same sort of thing. What is the first thing we're looking for? Waiting for that daily confirmation. We have the daily confirmation happen here. So on the close of that candle there. So if I did have a daily position, which I actually missed this one, which is really, really annoying, would have been just below the low, roughly there. So that would have been one position, which already in the last however long would have been, in the last month, we would already be up, depending on what we risked, about 5.9, maybe 6 or so return on whenever we risk. So if we risk 6%, sorry, if we risk 1%, that'd be 6% return. But if we miss this, or if we just wanted to scale in, what happens is after I've had that, then I move down to the 1 hour. And assuming everything looks okay, I'll just be waiting for the same thing again. You'll notice these boxes are already lined out, and they are lined out that way because of this. So simple. And you'll notice as well the amount of noise and clutter that you cut out this way. If you wanted to add additional things in here as well and be like, okay, well, I want to define it and add this thing that I already know about entries on top of this as well, you're more than welcome to do that. But I've just found that for the most part, there isn't really much of a benefit to doing that unless you are going for just monster account growth. Pardon the pun with Monster Beverages. But you've got to be careful with that because that often isn't as sustainable as everyone likes to think. And I would much prefer just to have a market that is predisposed to go up by a significant amount and get pretty good entries, and then let the actual real drivers of price, not lines on a chart, dictate the actual market going up. It means that I can be right and I can know why I'm right instead of just being like, oh, things went up. Cool. Like, I'd prefer to have things more organized and structured for me, but you may be different. But the real benefit to this is we are cutting out all of the noise of price. All of it. It's so simple. It's beginner friendly. It's easy as hell to do. And it also allows better entries if that's something that you want. If you wanted to take an entry over there, stop kind of roughly below the level without choking it, you know, you're still getting classic, nice, clean risk rewards. And if you wanted to refine it more, you're more than welcome to go to the 15-minute. You're going to run into more noise as you go down, but it's kind of like a domino effect. Once the daily's aligned, then I'll allow for the 1 hour. If I wanted to refine it further, sometimes I'll then, after the 1 hour is aligned, wait for the 15-minute to align. I won't go any lower than that. That's my personal system, the way that I like to do it. But that's it, guys. And I hope you've enjoyed this video. I'll leave a video up here for insights into how I'm actually going and selecting the markets that are predisposed to go up if you are interested in that. I know most of you may not be interested in that, but I'll leave it on screen for you right now. But I hope you have a great day, and I'll see you in that.